All right, guys, we are back. We are ready to get started with stock maturation. This is really eye-opening section. Make sure you take any questions you have, write down the page numbers. We'll come back to them during the Q&A session. Quick reminder, tonight replay will be 6 p.m. Eastern time. And this section on page 39, I believe will take pretty close to about 45, 50 minutes. So let's get started. Then we will have a 15-minute break after this section. Back to Mark.
Okay, we're back. I just want to recap. We talked about categories, right? Talked about the various categories, the market leader, the top competitor, the institutional favorite, the turnaround situation, and we put that into perspective on the various categories that you want to categorize a company first. The specifics of why and how we're going to apply tactics to each category, mainly in fundamentals. That's where really you've got to use different tactics and different categories. We're going to get into later. Okay, so we'll get there. Valuation. Basically, what we do is we dispelled the PE ratio as being very valuable as any type of timing tool or even a valuation tool. It's not a very good valuation tool. It does tell you whether a stock is cheap or expensive at the time, but it doesn't tell you anything about the future and where the stock's going. As a matter of fact, I would prefer to have a stock that had an above a PE that was above the market average. So let's say the S&P is trading at 20 times earnings. I'd much rather have a PE that's double the S&P trading at 40 times earnings than half of the S&P trading at 15 or 10. And certainly if it's trading at 4 or 5 times earnings, that tells me that something's wrong. It's just, being that cheap. So when you get below the S&P 500, the more you get below that, the more it's telling you that something's wrong and the future may not be so bright. When you're above it, it's telling you that there's a high expectation for the future. Now you just have to see if they're delivering. That's the main thing, to make sure the stock and the earnings and the fundamentals are delivering. But what we want to talk about now, and going back to where I said that the 95% club, the very first thing that I do when I'm looking for a potential stock to buy is I apply what I call non-negotiable criteria. This is what I would refer to as my qualifier. If it doesn't meet this criteria that I'm going to show you in just a second, then I don't even consider the stock. So this narrows my universe way down. This chops out a lot of the stocks that are going to be names that I don't want to waste my time on. And this is going to narrow down your list to a more manageable number of names. Now, the reason behind this, again, everything that we're doing here is not just something just came off the top of our head. This is all based on many, many decades of not only my own experience and anecdotal evidence and scientific evidence in real time, but also looking and factor modeling and going all the way back to the 1800s to see that the same thing was happening, when Coca-Cola in the early 1900s to Monster Beverage, in 2000 change. Nothing's changed. Nothing's changed with regard to earnings, sales, margins, your trend, momentum, alpha. Nothing's changed. So stocks will go through these 4 phases, and of course, my good friend Stan Weinstein is sort of the grandfather of this. I read Stan's book back in the 80s, and I was fortunate to meet Stan in 1990 in New York City. As a matter of fact, just a couple months ago, I think it was last month actually, I had dinner with Stan and his wife, and he always loves to talk about stocks and stage cycles and so forth. Great, wonderful man who's made an incredible contribution to trading and teaching traders. And so this cycle work is so important because this is the very first thing that you need to get right, or everything else is a moot point. Now, if you start looking at base breakouts and all the stuff that I'm about to show you later on, and you apply it to a stock that's in a downtrend, you're gonna be you're gonna have very poor results. All right, it's not going to work.
Mark, I want to add too. I think it's really important. You alluded to that everything here is based on timeless principles. this and works on really every time frame as well, that I often tell folks. People ask me, what's the content like? Everything here is timeless. If you go back and look at some of these charts from 100 years ago when Jesse Livermore was trading, or even earlier, I've looked at charts back in the 1800s. You see these same 4 stages. You see these same patterns continuing to set up and take place. So you don't have to worry about, well, what happens if this falls out of favor? Because it's not going to fall out of favor, at least permanently, because again, it's based on really solid, timeless principles.
Yes, absolutely. You're gonna, and we go back to again where I talked about how, putting the probabilities, in your corner. 98% of every big winning stock in the last 100 years, going back to the start of the stock market, it was in a stage, what I call a stage 2 uptrend, which I'm going to give you the criteria. 98% before they made their big move. So my question is, knowing that there's a 98% chance of being in the big winner if you're in the stage 2 uptrend, above the 200-day moving average, the 200-day in an uptrend, and a 2% probability of having the big winner if you're not, which club would you like to be in? You want to be in the 98% club, or you want to be in the 2% club? So knowing that, if you buy that's true, and this is fact, this is an opinion. This is fact that we're presenting. Who would ever want to have a 2% probability versus a 98% probability? So why would you be buying a stock that's down and broken? Now, can stocks that are down go up and are in downtrends? Absolutely. Absolutely. But I'm going to show you why it's a bad idea. And that's going to unfold as we go here beyond this section. Again, this is the perspective section. But now what you're not only losing price. Let's just say that, you buy a stock down and it doesn't go much lower. It doesn't turn into a disaster. You don't lose any money. Well, but you're losing time. They're losing time. When you go through these basing phases, so you're going through stage 1, stage 3, and that's what we break this down into. We break it down into 4 stages. Stage 1 is the basing phase. Stage 2 is the advancing phase. Stage 3 is the topping phase, and stage 4 is the declining phase. This is, like Mark said, timeless. You're going to go through these 4 phases, some faster than others. Some you're going to have where they go from stage 1, stage 2, back into stage 1. They rebase and they go back into stage 2 again. But you're going to go through this. What you want is you want to be gaining value as fast as possible. Okay, that's the goal. The main goal is to be not only gaining value, but doing it as fast as you can. Because again, if I can make 20% in 3 days, and I can do that a couple times, well, I just accomplished 100% return in a very short period of time, where you may buy a stock and you get that same 100%, but it takes 2 years. I'm going to make much more money than you. And that's how I make the big returns, because I not only know how to get the stocks that move, but they move quickly. Okay. So that's also part of it. Let me show you some.
Just look at this chart real quick too, Mark. I think it's a great example of, to any man's eye, where do you want to be playing? And you have a tremendous advantage over other players who either don't have this knowledge, don't have the discipline to follow it, or, are mandated to be in stocks and hold them through these gigantic, periods where just nothing is happening. Where in stage 2 here is where all the alpha is. That's where all the excitement is. And that's where you want to be playing. Ironically, I traded this name. I remember Weight Watchers really well. They had an announcement or something like that. The stock went into a new stage 2 and had a great move. But once you got off it, it went nowhere for years.
Yeah, I don't remember if this was the particular time, but Oprah had bought a big.
That's right.
Amount of shares. Yeah, the Oprah effect. So another thing that's important to mention here is that stage analysis is not a strategy. Okay, it's not a strategy in itself. And Stan Weinstein himself, who wrote a whole book on this, would tell you the same. I talked to Stan Weinstein like on a weekly basis. I talk to him at least every month. So I know Stan really well. We have dinner together. We talk about this stuff all the time. So I can tell you right now that he would tell you that it's not a complete strategy, just stage analysis in itself. There's more to it than just that. But this is the starting point. And Stan would never be buying a stock that in a stage 3 or stage 4 or stage 1. He's going to be buying in a stage 2, just like myself, just like Mark. Let's look at some examples. Weight Watchers, of course, lumber liquidators, like we talked about before. Here's another thing I want to point out. You're going to see a lot of times I'm going to show you the same stock. And the reason why is that we're going to build on it. I'm going to show you it in the stages. Then later on, I'm going to show you the base breakout that came from the point where I was buying it. And I'm going to show you the fundamentals that were in another section to that same name. And I'm going to show you when it topped. So you may see some of the same names over and over, but we'll be building. We'll be building on the information and building. And so at the end of this, you have a complete picture. And it's like all these pieces of the puzzle are going to come together. Okay. So again, stage 1, stage 2, you see, this is, as Mark said, this is where all the excitement is. This is where all the gain is in the shortest period of time. Then you go into a quick stage 3, you top, and you're in a stage 4. Now, if you were to look at put some moving averages here, you're going to see that, and I'm not sure, let me just see, do I have the examples? Yeah, okay, we're going to get to that in just a second. You're going to see that you're going to be above the 200-day moving average, and the 200-day is going to be an uptrend during the stage 2. In the stage 3, you're going to flatten out. You're going to be whipping back and forth, and it's going to be more volatile. In stage 4, you'll have a mirror effect of the stage 2, where you'll be below the 200-day, and the 200-day will be in a downtrend. Also, going back to Stan, because in Stan's book, and everybody should read Stan, if you're interested in stage analysis, you should read Stan Weinstein's book. He has switched over. He started with the 30-week moving average when he first wrote the book, and he has since switched over to the 200-day. I use the 200-day. You can use the 30-week. It's pretty effective as well. But again, he has, and I don't even know when he made that switch, but he does use the 200-day now, just as a note. Crocs, very short stage 3. It topped very quickly on an earnings report and just got blasted. But again, you can see here, you don't want to be involved here. Stage 1, you're losing time. Stage 3, you're losing time. Stage 4, you're losing money and time. Stage 2, you're gaining value and fast. And that's what the only place you want to be. Okay, that's the key of all this, is we want to convince you that you only want to be in this one stage. Now, this is a stock. This is Lulu. This is where I was buying Lulu, right here. You see, you're already in a stage 2. I'm not trying to guess or play it in stage 1 or stage 4. We're already in a stage 2, and it starts breaking out. You see it accelerates very quickly. That's what I want to get at a profit as quickly as possible. Now, here in stage 3, what'll happen is very often, just like I'm going to go back here and show you Crocs. See this big break here? That's institutions. That's, as O'Neill used to say, I don't know if he said Betty or he said Sue, but someone's aunt. That's not Aunt Betty selling there. That's not Aunt Betty with all this volume and this price. Those are big institutions. You go back, you look at Facebook right now, you'll see the same thing. It just broke just recently for a second time. Those are institutions unwinding these positions that were built up through stage 2, all the way up, and you've got these big profits. And now you've got all this ownership. They become institutional favorites. They become quality companies, like we talked about. See how everything's chronological here. Everything that I tell you, another point I got to make real quick, I forgot to say this, but everything that I tell you previous is never negated by anything I tell you afterwards. So we are going to build upon everything that I tell you is just a step in a staircase. So we're going to keep building upon it. And so just keep that in mind.
I just want to point out too, Mark, if you look at this chart, and this is a classic textbook example, and I remember this Crocs chart from the first Master Trader program, that break on volume, biggest decline, biggest volume, I think it might have even been at the time in the history of the stock. I don't remember.
It was.
But we just, to your point, we have been in an environment, when a stock does that, it is signaling, to your point, there are major, huge sellers that are taking profits and getting out. And we've seen this now literally in the last 3 to 6 months, how many stocks have done exactly this. And you've seen how many people on Wall Street saying, oh, they're a great buy here. And all of them have gone lower.
Yeah, absolutely.
All of them. almost 100% of them have gone lower because the institutions are what is driving this. And this is one of the things Mark and David Ryan, looking at volume, it is obvious that is elephants piling out of the tub, which means the water level is going to go lower. And every time I'm shocked at the number of people that continue to say, oh, it's a great buy down here.
Amateurs love to buy on big breaks like this. They'll buy Facebook, they'll buy Amazon, they'll buy Microsoft, Google on a big break like this. That's why they're amateurs. Pros are selling here. That's what this is representing. And sometimes you get some bounces, you get some oversold bounces, but these are big sell signals. That's you're entering that stage 4. And what I was pointing out before was when you're in stage 3, at some point to really understand whether if you're heading into stage 4 or how certain you can be that you're in the stage 3 and you're topping, is you'll start to see these large breaks. And sometimes the stock doesn't break yet, doesn't fully break. It even rallies back and it takes more time. Sometimes you get that first break and it takes a year before it actually tops, but you lose a lot of time and you don't really get anywhere. And there's a lot of volatility. And then finally it breaks again and it starts gapping and it unravels. So again, differentiating and knowing when you're in stage 1, 2, 3, or 4, what's really important is I'm not too concerned whether I'm in 1, 3, or 4. I just want to know how to identify stage 2. I always tell people, you don't have to know all the things not to do. You just need to know the things to do. There's only a few things that you need to do, but there's millions of things not to do. So don't overcomplicate it and try to figure out what does a stage 3 look like. As long as it's in stage 2, that's what you're concerned with. Anything other than stage 2 criteria is one of the other 3 stages. All right. So we take a look at some of these names. TDOC, this was one that was a leader, made a big move. Everybody loved it. Now you're in stage 4. You don't need moving averages. You don't need anything to see this. It's very obvious. You can also see that this left side is characterized by lots of blue. Those are up weeks, and this is a weekly, it's weekly, up weeks, right, on volume and blue. And then look at all the red volume, the red bars. That's all down. You just see the contrast between the two, right?
Mark, if you look at that too, just to point that out, perfect example of how you get those large, big red bars as it's going into stage 3. There's none of that when it's in the stage 2, except for maybe one bar. But up there at the top, as it's topping, again, those are institutions that are selling and putting in the top.
Zoom, another one. Another favorite there. These were short-lived favorites. These are more flash in the pan. Like you go back to 1988, 89, LA Gear. LA Gear was a stock that I held for a 400% move, and then it just got clobbered and unraveled. But it was a fad. And really all they did was they put glitter in the laces. They had colored laces and glitter in the laces. Nobody had ever done that before in these sneakers. And it was probably a little more than that, but that was the main thing that I saw. The kids were wearing them, and I called around. There was Foot Lockers at the time in malls. I called a bunch of Foot Lockers. I said, hey, are these LA Gear shoes, are they selling really well? Guy said to me, man, if I had 50 cases of them, I couldn't keep them. They're selling so fast. I called California and I asked a few places out there, how the LA Gear sneakers selling? They're like, oh, the hottest thing, and the stock was breaking out of the base. The earnings were triple digit earnings over the previous 3 or 4 quarters. I bought the stock. Matter of fact, I told my uncle Benny, who loved the stock market, he actually got me interested in it somewhat. And I gave him the stock, and the stock went up 400% from there. I was a big hero with my uncle. Unfortunately, he held it all the way down. I sold it. Anyway, that's a whole nother story. So I'm going to be interested in a stock after it's coming out of the stage 1. It's getting into the stage 2, and you can see I'm not the only one. If you take a look at the volume here, look at the contrast in volume. You see the volume here that's relatively low, and then when it starts getting at the stage 2, look at how the volume on average is much higher. That's institutions. That's what you want. You want to be riding the backs of the institutions. Here's the key, though, and this is another thing that I probably should have told you up front, but I'm going to give you the techniques, the same tactics and techniques that the institutions use. The difference is that you don't have to buy 1 million shares. You don't have to go to an approval board. You don't have to have analysts make all these big glossy bound reports and make this big case and bring it before your board and get it approved, and then go buy all these shares that represent this big giant position that still doesn't even represent a very big position of the fund. Even if it doubles or triples, it doesn't even have a big impact because they can only take so much size because of risk and so forth, and report to shareholders and all these things. Think of that as a big cruise ship that can only move so fast and turn around very slowly, and you're in a speedboat. You're in a speedboat. You can move quickly and you can turn around in a second. You can sell, you can buy, and your speed and your agility makes you superior to even information superiority. Even the funds that have analysts, people go, well, I can't compete with the pros. They've got armies of analysts, and they go to the company and talk to the suppliers and the vendors, and they know everything about the company. Yes, that's true. They have to, because they've got to make this big giant case, because they can't get out. They can't get in very easily, and they can't get out very easily. So they've got to make certain that, as certain as they can, that if something goes wrong, they know what's going on in that company, and it still doesn't work. It still doesn't work because things can change very quickly in business. Conditions can change. The economy can change. A war can break out, and you have the advantage of being relatively small. Even if you have a $10 million portfolio, which is probably more than most people in the world, it's still very small. It's very small. Anyway, let's move on.
This is an extremely important point, Mark. I just have to jump on, though. And the idea being, because you hear all the time that, well, things are disadvantaged for the little guy. And I just think it couldn't be further from the truth. That's my own story, by the way. So I'm telling you my own story. I started small, and there's no question. Especially armed with the information you're getting here. But if the analogy I often give people is, if we're playing chess and there are moves that I can make that you cannot make, who has the advantage?
Right.
Me.
Right.
And that's precisely, there are moves you can make, cash, and the ability, like Mark said, in some cases you're riding a jet ski, off their wake, off these institutions, is a tremendous advantage, over them. And I just can't stress that enough. The individual has a huge advantage in this game, but you have to, again, be using good criteria, discipline, and all the things that we're going to be talking about over the next,
Yes,
days.
you still have to you have to be able to maneuver that boat and drive it, because with speed and agility comes risk also. And I was fortunate to understand this a long time ago. Now, I didn't have the skill to take advantage of it or apply it. I did understand that there was a big advantage to being small. I did not know how to take advantage of it, though, for years. It took me almost a decade before I realized how to drive that speedboat and to maneuver it properly. But once I did, it was lights out. The rest was history, and it changed my life. So again, let me show you. So very smart people still make very big mistakes. They just make bigger mistakes. And very often they make it with other people's money. That's another thing. Here's a Valiant Pharmaceutical. If you remember, this was a very, most of you, I won't have to mention the name of the big investor, the big hedge fund manager that was buying this, all the way down pretty much. And again, this would be completely off my radar. If it's not above the 200-day moving average, well, I'm not even going to look at it. So before it even went into that big nosedive, you shouldn't even be considering this stock. And that simple rule right there, I think, Mark, you were talking to me about, if in the recent market, what would have saved people tons of money if they just followed one rule. Looking back